For more on the markets and all of this, let's bring in Jefferies chief market strategist David Zervos. What do you think the takeaway is from the market reaction to the Fed and whether uncertainty is going to reign here?
Sarah, I think you guys hit on a lot of the important points, and uncertainty is higher. We have a new president coming in. We've got a lot of new policies. People are debating tariffs, immigration, deregulation, energy policies, lots of different things to put in the pot and figure out for 2025. And we also know that historically this Fed has not been, at least the Powell Fed, has not been that cooperative with the Trump administration. And I think we saw a little bit of jitter that might be happening frequently in the beginning of 2025 and into the end of it as well, where the Fed and the administration may not be always on an alignment path. And the market kind of got a little messy on that. I don't expect it to be like 2018. I don't think it's going to be a real fight, but I think the market doesn't like to see that, and they kind of got shades of it. And that was a bit of what happened on Wednesday. It's nice to see the PCE data come out the way it did. I was very happy with that. And I think that's really the story, is we're going to start to see much more disinflationary data in 2025, and then the debate will be over, and the Fed will be cutting, and possibly cutting far more than 2 times.
So then, David, you do not agree with Torsten Slok of Apollo, as Sarah was just referencing, among other things, suggesting that the 10-year will move above 5%, that there's a 40% chance of that happening, just as he says 40% chance the Fed's actually going to hike rates next year. Agree? Disagree?
I disagree. I love those 30, 40% numbers because you're never really wrong. If you say 30 or 40, you're like, well, if it happens, I called it. If I didn't, I said it wasn't a sort of a likely thing or above.
Forget the probability, but the idea that you could have rates moving higher that would be uncomfortable for the market. Let's start there.
I think there's a much lower probability of that, Scott. I think it can always happen. You never rule anything out, but to me, it's like a 10 delta, maybe even single digit delta story. I think the real story is one that we should focus on: the deregulation and the smaller government. People are over-focused on tariffs. They're over-focused on immigration. They're getting very hot and bothered by inflationary problems that I think are really going away and have gone away in a big way. I really thought Jay, talked in the big picture about inflation in a very positive way, that they've come so far over this last 2.5 years since we peaked at over 9% in the CPI. We should focus on the good news and what happened as they fought back that incredibly high shock on inflation. And I think that's going to be the story for 2025, led by Dereg. What's that?
They haven't gone away, David.
What hasn't gone away?
They've sort of, the inflation pressures, they've come down. Yes, it's great progress to go from 9% to above 2%, but the Fed's target is 2%, and we're not there.
Yeah, well, we're a lot closer than when we were at 9,
sure.
That's for sure. And I think we've had one of the fastest disinflations in post-World War II history, Sarah. This is 2.5 years, and we've come down so far. So the thing that I'll always kind of push back on those that want to get hot and bothered about inflation is that we never saw long-term inflation expectations, the 5-year, or any of the survey data, break significantly to the upside. Even when inflation was at 9, we saw 5-year break-evens at 2.5. They've been 2 to 2.5, basically lockstep for four years now, if not more. And the Fed has really, I think, won that battle. They anchored inflation expectations. We may have a little more work to do. We may get a shock. Oil may go up for a little while, may come down. We'll see what happens. There's always the vagaries of market data. But I think the trajectory is very much one of disinflation back toward 2, possibly even lower. And I'm just optimistic on the deregulation story. I think that was the biggest part of the Trump administration's moves in 2017, 18, and 19. It dominated tariffs. It dominated the fiscal largesse stories that everybody was worried about. And we had very little inflation in those first 3 years of Trump. And I think we're going back to something like that.
If we're over-bothered, as you suggest, on tariffs, on immigration, on inflation, then what kind of return do you think we can expect in 25 for the S&P?
So I would be looking for something again in the 15 to 20% range, possibly a little bit higher if the rate view starts to cooperate. If the Fed cooperates with the administration, and if we don't see a kind of battle line like 2018 start where we're debating neutral might have moved a little higher and we don't need to go so low, I really think there's a risk, Scott, that the Fed is going to overstate neutral, that they've misunderstood what happened, particularly with the balance sheet, something Sarah and I have talked a lot about on this show, with the balance sheet over the last 2 or 3 years. And they're misinterpreting that stimulus from the balance sheet that's been in the markets and been given to us as a reason to have a higher neutral rate. I think we're going back to 2019 level neutral rates, and that's basically 2 to 2.5%. If we get there quickly, this market rips. If there's a fight and they say, oh, no, it's 3.5, then we're going to have a little bit of a slower slog, and we might have some bumps along the way, which are fine. We'll just have to play those bumps as they come. But I think that's the story, is we're going back to a 2019-style neutral rate. Nothing in COVID changed the permanence of the neutrality concepts that we had going into the shock of 2020. And that's my call. That's a big, different, unusual call from everything else that's out there on the street, certainly from my friend Torsten, who's got a very different view on it.